Hey guys, and welcome back to another episode of the 365 Days of Forex series. In this video, I'll introduce you to the basics of technical analysis, including structure and trend lines, as well as some very important issues with technical analysis. So without further ado guys, let's get into today's video. So let's start with the all-important question: what actually is technical analysis? Technical analysis is described as the study of price action, mainly through the use of charts in order to forecast and predict future price trends. There are three key principles of technical analysis that you need to be aware of. Price action discounts everything, price moves in trends, and history will repeat itself. I'll cover these concepts in just a moment, but first we need to actually understand why technical analysis works and the reasons that it can be used to increase the probability of being correct when looking to enter positions. The reason for this is simply down to the increasing popularity of retail trading. Many traders learn the same concepts and theories to analyse the markets. If these traders then all have the same outlook on where price will move, then generally the market price action will reflect this. This is the main reason that we tell people to trade with the mindset of a bank, which is something we're going to cover in a lot more detail in the future. By trading like this and following the same methods that traders with 7 and even 8-figure trading accounts use, you're often going to be trading with price in your favour rather than trading against the majority and subsequently losing all your money. It all boils down to following the money in trading. If you're going against the market consensus, one of two things will happen. You'll either be early to the trend reversal and monopolising the bigger move, or more commonly, you'll be caught out on the wrong side of the dominant move. It's also a known fact guys that if you don't hit that subscribe button and like this video, you'll get 100,000 years of bad luck and there'll be Forex gurus underneath your bed. So, now you have a basic understanding of why technical analysis works and you've subscribed, let's run through the key principles I mentioned before. Price action discounts everything. In principle, this means that price reflects all available information that affects this market. Price action will also include hidden fundamentals which are only known by a few market participants. If prices are rising, demand is greater than supply, and when price is falling, supply is greater than demand. The next key principle is price moves in trends. This principle originates from Charles Dow's theory that price moves in zigzags rather than straight lines. Price movement is generally categorized into three sections: uptrends, downtrends, and ranges. The last principle is that history will repeat itself. This is arguably the most fundamental principle and the main factor that allows technical analysis to increase your probability of being correct when done properly. This principle refers to the theory that investor and trader behaviours tend to repeat themselves over time. This means that if you can identify notable price patterns, you can predict similar future areas of structure, and in theory, the pattern should produce the same result as it did previously. As we know from previous videos, it is actually for fundamental reasons that currency pairs move. However, if trying to analyse the chart with fundamental analysis, it's actually quite hard to quantify where to place your stops. As John Maynard Keynes once said, markets can stay irrational longer than your eye can stay solvent. However, this is where technical analysis comes in. With technical analysis, you can easily see when your analysis is wrong due to your setup becoming invalidated. This gives us a really clear signal for us to exit our trades, which is very hard to achieve when using fundamental analysis. Another thing to bear in mind is that because technical analysis allows our stops to be placed tighter, you can use this to your advantage and leverage your money in your trading account easier than with fundamental analysis. However, always make sure you're following correct risk management and sticking to something such as the 1% risk rule. Now let's get into the juicy stuff and take a look at support and resistance. In general, a horizontal support or resistance level, often called an S&R level, is an area where price has previously reacted to. Support and resistance works on the premise that if price is reversed at this level before, it's likely to do so again. Although typically plotted as a line, it's better to think of S&R as an area or a zone. Alongside price action, SR is probably one of the most common forms of technical analysis used. You decide whether you're looking at a level of support or resistance by looking at the level in relation to the current market price. If price is above the level that you've identified, it's referred to a level as support. If price is below the area that you've identified, is referred to as a level of resistance. You can think of SR as a floor or ceiling, as well as supply or demand zones. To explain this a little further, the way that you can think about this is that supply is an area where sellers are likely to be overwhelmed by buyers, causing the market to go down, which is the equivalent to resistance. The opposite of that is a demand zone. This is where buyers are likely to overwhelm sellers, which of course is equivalent to support. If we keep this in mind, it only makes sense to buy at support and sell at resistance. Perhaps the most important thing to remember with support and resistance is that if price is above support, you should be looking to go long, but if it's below resistance, you should be looking to go short. It is critical to note that price often breaks one of these areas, and it will sometimes treat it as the inverse. Therefore, if price breaks through a level of resistance, it will likely use the same level as support the next time that price comes to test it. Of course, this is true for vice versa, as when price breaks through a level of support, it will likely use the same area as resistance in the future. Now let's move on to considering how the market actually moves. As I discussed earlier in the video, the financial markets don't move in straight lines. Instead, they move in zigzags which form tops and bottoms in the market. And we can look at the sequence of tops and bottoms to identify the trend within the market. Take a look at the example right here for an example of how the market moves in zigzags rather than just straight lines. One of the most important quotes you can remember in trading is that the trend is your friend until the end when it bends. This essentially boils down to the fact that if you're going against the grain, you're probably going to get burned. It's a lot more probable that a trend will continue rather than reversing. Therefore, sticking with the trend rather than betting against it is typically the way that most larger traders have made their money. This methodology is commonly referred to as trend following. So digging a little deeper into trends, I will tell you that there are three types of movement in the market that you need to be aware of as a beginner. This is because different trading systems work differently in different market conditions. The first that we need to be aware of is uptrends, which are formed when price is making higher highs and higher lows. This is super easy to spot as price is going upwards. Take a look at this example right here and see if you can spot the higher lows as well as the higher highs. A range is formed where price is forming horizontal highs and horizontal lows. This type of movement is often given different names such as sideways price action, a consolidation period, or a ranging market. Again, take a look at the range right here and see if you can spot its characteristics. Now that you're aware of what a trend is, you need to know the basics of what you should look for, what to do, and when you're assessing the markets. When you've identified an uptrend, you should look for buy positions. And when you've identified a downtrend, you should look at sell opportunities within the market. When you're just starting out, if you find the market is ranging, you should probably avoid entering positions until you've developed a trading system that works well in ranging markets. The reasoning behind this is that ranges are often filled with market noise, which is definitely a hard situation to trade, especially if you're a beginner. Another thing to make sure of is that you're not getting caught out when looking at trends on shorter time frames, as this is because they can be the complete opposite of what the actual longer term trend is. To avoid this, make sure you're identifying your major trend lines on a weekly or daily time frame to get a better grasp of the longer term trend before you jump in on those lower time frames. Whilst it's great to be able to identify levels of support and resistance and the general trend, it becomes super confusing to remember all these different variables, and that is why we mark the trends in our chart with trend lines. Trend lines are essentially a connection between the swing lows in an uptrend and a connection between the swing highs in a downtrend. A super easy way to remember which side of price you need to draw your trend line on is to think of your trend line like a level of support or resistance. In an uptrend, we want to see price retesting the lower levels of the uptrend whilst forming higher highs and higher lows, which means that we can get a good indication that the trend is reversing if price breaks through the trend line to form a lower low. The same thing applies to a downtrend. We want to see price forming lower highs and lower lows. We all know that price is beginning to reverse if it forms a higher high, and this is a characteristic of an uptrend. If we have our trend lines marked incorrectly, then we should see price pierce through these trend lines at this point, and therefore we'll know that a trend has reversed or is beginning to reverse. Drawing trend lines can be super simple, however it's easy to get caught up drawing trend lines all over the place that are completely wrong and are irrelevant. Make sure that you're only drawing in the obvious trend lines. If you need to force a trend line, then it's likely that a lot of traders will miss it and won't be looking at the same area that you are, which will obviously reduce the probability of your setups being profitable. A really common question that I get asked all the time is whether you should draw your trend lines from the body or the wicks of the candlesticks. At the end of the day, it's really down to personal preference of you as a trader. The only thing that matters is that you're consistent with whatever it is. That is, if you draw your trend lines from the bodies of the candlesticks, then always draw them from the bodies. And if you draw them from the wicks, then obviously always draw them from the wicks. Don't just chop and change this between your trading setups, as you'll likely see a lot of inconsistency. The second question is whether the gradient of the trend line matters. From my experience, I've found that taking a Goldilocks approach to drawing trend lines is best. You don't want your trend line to be too steep, neither too shallow. You just want them to be just right. Let's take a look at this in a lot more detail. If the trend line is too steep, it is likely that price will exhaust, as the momentum that price has will generally fade, as we can see here. If the trend line is too shallow, then it's likely that price will have a little momentum in direction, which means the trend line could be prone to reversals, as we can see in this example. From my experience, I've found that trend lines that are between 30 and 45 degrees are often the most likely to be respected. This is the closest angle that I've found, which could be referred to as a so-called perfect trend line. However, realistically, price never has to respect a trend line. If the majority of big players in the market are expecting to see a reversal, then guess what? A reversal is probably going to happen. When you're drawing trend lines, it is vital to have major trend lines which show higher time frame trends, such as the daily and weekly trends, within the market, as well as the minor trends which can be drawn on, say, the hourly or 4-hourly time frame. If you want to use trend lines effectively, then you should look at having major and minor trend lines suggesting the same thing. If one is in an uptrend, the other should also be in an uptrend. One of the most common ways to utilise this idea is waiting for a counter trend line to break on the minor time frames, which will then cause price to trend in the same direction as the longer time frame buys, which would be an additional confluence to enter a position. So that concludes our introduction to technical analysis in this video. Don't worry though, we'll be going into much more detail with all of the topics that we discussed here, starting with Japanese candlesticks this Friday. So guys, as always, if you liked the video, hit that like button and of course subscribe to see more content just like this. Cheers guys, and I will see you in the next one.